Hello and welcome to the analysis. As the U.S. market is closed for the weekend, we're looking at the final figures from Friday, November 7, 2025. Rezolve AI PLC, trading under the ticker RZLV, finished the session at $3.84. This was a challenging day for the stock, closing down 7.25% and settling at the absolute low of its trading range, which saw a high of $4.237 earlier in the session. This price action comes on heavy volume, with over 9.4 million shares changing hands, significantly above its average. This is a stock that has been on an absolute roller coaster, with a 52-week range stretching from just $1.07 all the way up to $8.45. The immediate data shows a stock under pressure, closing at its low, yet the story investors are being told is one of explosive, world-changing growth. This is the central conflict for anyone looking at Rezolve right now, and it's what we need to unpack. The expectation, the narrative being heavily promoted by the company and cheered on by its bulls, is that Rezolve AI is the future of e-commerce. The company positions itself as the engine for what it calls agentic commerce. The idea is that its Brain Suite platform, which includes tools for multimodal search, one-tap checkout, and even crypto-to-fiat payment processing, will allow autonomous AI agents to handle transactions for consumers. The company has been relentless in its press releases, announcing major partnerships with Microsoft and Google, and a client list that supposedly includes global titans like Ferrero, H&M, and Urban Outfitters. Just last month, in October, Rezolve Management dramatically raised its guidance. They are now projecting a 2025 annual recurring revenue, or ARR, exit rate of $150 million and initiating 2026 guidance for a staggering $500 million ARR exit rate. When investors hear this, they see a company on the verge of exponential growth, partnered with the biggest names in tech, and they look at the current market cap of roughly $1.18 billion and feel it's deeply undervalued compared to peers like Anthropic or Sierra AI, which trade at much higher revenue multiples. But then we must look at the reality. The reality is that this $1.18 billion valuation is attached to a company whose trailing 12-month revenue is just $5.3 million. The reality is that while the company guides for massive future ARR, its net income over the last year was a loss of over $217 million, and its cash from operations was a burn of over $36 million. The stock's close at the low of the day on Friday suggests the market is deeply skeptical, and that sellers overwhelmed buyers into the bell. This is the disconnect. The story is about a $500 million revenue company, but the financials are those of an early-stage, cash-burning startup. This gap between the bullish expectation and the stark financial reality is where the immense opportunity and the profound risk reside. The recent volatility is a direct result of this battle, with the stock having fallen more than 50% from its 52-week high, even as the company's announcements have become increasingly optimistic. This brings us to the activity from larger investors and the short side of the trade. This isn't a stock with a massive, obvious short squeeze setup. The reported short interest as a percentage of the float is relatively low, hovering in the single digits, around 3.8%. The bearish case here is not built on a squeeze. Instead, the short thesis is far more fundamental and, frankly, more traditional. The bears and potentially some short sellers are looking at the same discrepancy we just identified. They see the negative outlook noted by some analysts who point to near-term gross margin contraction as the company tries to build out a new professional services division. More importantly, some analyst models are projecting 2025 revenue of around $46.4 million. This is the critical detail. How can a company be guiding for a $500 million ARR exit rate, while analysts are modeling only $46.4 million in revenue? Here is the actionable insight for everyone watching. You must understand the difference between annual recurring revenue exit rate and actual recognized GAAP revenue. An exit rate is a forward-looking projection of how much recurring revenue the company will be booking on a run-rate basis by the end of the period. It is not the total revenue the company will collect for the entire year. The short thesis is likely that the company is using this impressive-sounding metric to mask much lower current-year recognized revenue, all while burning through cash. The bears are betting that the $217 million net loss is the more important number, and that the company will struggle to reach profitability before it needs to raise more capital, potentially diluting current shareholders. For you, the investor, you must not just read the press releases. You must go to the SEC filings, the 10Q and 10K, and find the income statement and the cash flow statement. You need to track the actual recognized revenue each quarter, and most importantly, the quarterly cash burn rate. If that cash burn isn't shrinking as the new clients are supposedly onboarded, the short thesis gains strength. What's your take on the institutional buying? Is BlackRock and Citadel's new position a signal that the long-term story is real, or are they just taking a small flyer on a volatile name? Let me know your opinion in the comments. On the other side of this trade, the bulls have some very powerful data points. In September, the company announced that institutional ownership had officially surpassed 10%. And these aren't small funds. The names listed include Citadel, BlackRock, Vanguard, and Jane Street. This is what Wall Street calls smart money. These firms have entire departments dedicated to tearing apart financials. Their willingness to take positions, even if small relative to their total assets, provides a significant countersignal to the short thesis. It suggests they believe the technology, specifically the BrainPower LLM, that Rezolve claims is competitive with GPT-4 without the hallucinations, is legitimate. They are likely buying into the long-term agentic commerce narrative and are willing to sit through the cash burn phase, betting that the $500 million ARR target is achievable. This was complicated slightly by an announcement in October that a large block of 10.6 million shares tied to the estate of the CEO's late father was transferred to a new leading global institutional investor. While the company framed this as a positive and responsible part of estate administration, any large insider-affiliated transfer will make the market nervous. So, what does Rezolve AI actually do? At its core, it is a business-to-business AI platform for e-commerce. Its Brain Commerce tool allows a customer to use conversational AI or even take a picture of something to find a product on a retailer's site. Its Brain Checkout tool is designed to be a seamless one-tap payment system that integrates loyalty programs and, as mentioned, can even handle crypto-to-fiat payment processing. The company doesn't sell to consumers. It sells this platform as a service to large enterprises, charging them recurring fees. The company claims its infrastructure is already handling massive scale, citing 1.6 billion search sessions and 13 billion API calls in the first 8 months of 2025. The entire bull case rests on the company's ability to successfully monetize this existing usage and rapidly convert its pipeline of over 100 enterprise customers into paying, high-margin subscribers. Looking forward, the picture for Rezolve AI is one of extreme polarity. There is no middle ground here. The path ahead is entirely dependent on execution. The expectation has been set by management: $150 million ARR exit rate in 2025, $500 million by 2026, and a claim of potential operating profitability by the first half of 2026. The reality is a stock closing at its daily low, a significant negative cash flow, and massive net losses. The next 2 to 3 quarterly earnings reports will be the most critical in the company's history. Investors will need to ignore the noise and look for 3 specific things: a significant sequential jump in recognized quarterly revenue, a meaningful improvement in gross margins, and a stabilization or ideally a reduction in operating cash flow. If the company delivers on these, it will prove the bears wrong, and the institutional buying from BlackRock and Citadel will look prescient. The valuation gap will close, likely by the stock price moving much higher. However, if the upcoming reports show stagnant revenue growth despite the client announcements, or if